The United States Government Accountability Office, otherwise known as the GAO, released a report on crop insurance earlier this year. It suggested two ways to save money on the federally subsidized crop insurance program. Congress reported the GAO could consider limiting the subsidy for premiums that an individual farmer receives each year, or reducing the subsidy for all farmers participating in the program. Of course, it could do both. With the Farm Bill debate raging in Congress, the ag economist at Illinois wondered what would happen if the GAO's recommendations were made law and the limit was set at $40,000.
The farm sizes that hit that limit were 1,600 acres in 2011 up to 2,700 acres in 2010. So something in the 1,600 to 2,700 acre farm size, grain farm size, would begin hitting those limits. That varied by year because projected prices varied by year, and that influences premiums.
Those farm sizes are bigger than the average in the state of Illinois, but not by much. The average grain farm is about 1,200 acres. Limiting the insurance premium would mean the farmer would bear the entire cost of the premium for acres insured over the subsidy limit, in this case $40,000. Such a limit would change the influence of crop insurance.
There's a couple things about that. So far, the Risk Management Agency has been pretty size neutral in its programs. This would not be. It would limit the risk program to larger farms, and there are differential impacts of that $40,000 limit. Areas that have more risk would have lower acreage limits because their premiums are higher.
That's not just in Illinois. The change, if considered and enacted by Congress, would make it much more difficult and costly to insure marginal farmland. For University of Illinois Extension, I'm Todd Gleason.